Today we're talking about dividends, in particular dividend investing, right? So Danny, I know you and I both have things to say on this topic. For our listeners who may not be familiar with it, or even for those who are, just some quick housekeeping. For today, we're going to be talking about a particular type of dividend. You're going to hear that term from time to time. Some people refer to it as it's used very broadly, like if you do this in your life, it will pay dividends, right? And it's kind of used as this loose term of like a return on investment for something you do. Certain bond funds pay dividends. Certain whole life insurance policies that are participating policies will pay dividends to their policyholders. This is one of my personal favorite dividends, REI, where I do a lot of my shopping for outdoors equipment. My wife and I like to go there. Members get a
Nice.
10% dividend. But if I'm being totally transparent and honest, if you think back to the credit card dilemma episode where I was talking about rewards influencing your spending behaviors, the 10% REI dividend may or may not influence our spending behaviors.
A little bit guilty there.
Yeah. Anyway, those are not the types of dividends we're talking about today. We're talking about dividends paid from stocks, from companies, right?
Okay.
And you may own individual companies. Maybe you own a stock fund or a stock ETF, for example. Those are the types of holdings we're going to be discussing today. These companies that pay dividends to their shareholders, and why somebody might be interested in that type of philosophy or that type of strategy.
I wanted to jump in real quick and just call out. I noticed something interesting. You mentioned bond funds paying dividends. That's very interesting when you think about it, because a bond by itself does not pay a dividend. It pays interest at its
Correct.
interest or coupon rate.
Yeah.
When you combine individual bonds together into a bond fund, then it pays dividends rather than interest on an individual.
But yeah, so back to the main topic though, to our listeners, in case you don't know, what the heck is a dividend, right? Like, what does that mean when a company pays a dividend? The simplest way to describe it is it's simply a distribution of the company's earnings or profits, if you will, to eligible shareholders. It's just a way for them to return some of the earnings to their shareholders in the form of a cash dividend. There are some things called stock dividends where we're not going to be talking about those today, where they actually issue stock instead of cash. That's not going to be the topic of today. Fun fact, before we jump into some more of the nitty gritty, Danny, I was doing a little bit of research. I saw a YouTube video of Warren Buffett. Many people consider him one of the greatest investors who've ever lived.
Pretty easy to be so, or to do so when you've been investing for 80 years.
Yeah. The time of compounding growth was very much on his side, but I don't want to downplay his intellect.
Sure.
He's a very rational investor. I remember watching a YouTube video of him at I think it was one of the Berkshire Hathaway conferences, I think, and he was talking about how the annual dividend he receives from Coca-Cola that he bought, like his original investment back in the 80s when he started investing in it, the annual dividend is larger than his original investment amount.
That's pretty amazing.
That's ridiculous. I mean, I guess when you own something for that long, it could potentially grow to a size where the dividend itself is larger than what you originally put in. But that would take quite some time of a holding period and also a lot of capital appreciation.
Yeah, 40 years in this case.
That is not advice to purchase Coca-Cola, by the way. None of this should be taken as investment advice. So moving on, what can a company do with its profits, right? When a company pays a dividend, when it returns cash to its shareholders, they're really making a decision about capital allocation, right? Like, so a company has profits. What can they do with those profits? They can pay down debts. They can buy back their own shares if they want to increase their earnings per share. They can acquire other businesses, right? They can do some type of merger acquisition. They can reinvest into their company for continued growth. Maybe that's expanding the business in some way or putting money into R&D, research and development, whatever it might be. Or they can return profits to shareholders via a dividend, right? That's what we're talking about today, is returning those profits to shareholders. Now, why does a company pay a dividend? Danny, what are your thoughts on this? Like, when you think about what reason does a company have to pay a dividend, what comes to mind?
Well, most of the time, companies that pay dividends are well established. They tend to be on the older side. They've been around for a while. And, there's a couple different reasons. One is that maybe they've just kind of hit the size and growth point where just throwing money into R&D isn't going to net them the same returns that it did previously. And they can kind of deliver some additional value to their shareholders by returning those profits in the form of a dividend, paying that dividend out to shareholders rather than trying to continue to expand the business. Coca-Cola obviously gives a dividend based on that Warren, Buffett fact we just discussed. And Coca-Cola is an enormous worldwide company. And it may just be that they don't have the capacity for expansion that, existed, say, 30 years ago. And it makes sense to pay some of those profits out. Otherwise, in some cases, the company just ends up stacking cash in, bank accounts, and it's not doing much, and they can reinvest it somewhere else, I suppose. But it comes to a point, or you reach a certain kind of tipping point where it is more beneficial to pay, those shareholders dividends. It also, dividends for a lot of people make stocks more attractive. And so people are more willing to hold them for the long term. There's a lot of different reasons. There are even some companies that are set up purely with the express goal of earning dividends and paying those back to shareholders. REITs come to mind. Real Estate Investment Trust. They're required to pay, I think it's more than 90% of their profit directly back to shareholders in order to maintain
I think that sounds right.
kind of tax favorability. So there's many different reasons that a company might choose to pay dividends.
I loved that answer. I think it was much better than I was going to be able to say. You're right. The traditional reason is that they feel the investor can earn a greater return themselves than the return the company could earn by just reinvesting it into their company. And like you said, that's usually when a company hits perhaps a certain stage of maturity, less focused on growth. They're becoming more stable, and they want to reward shareholders with steady stream of company profits.
Yep. Very
Absolutely.
Unlikely that you're going to see a startup paying dividends to shareholders.
Right. Yeah. In fact, that may be a red flag, right? If you saw that, you may be asking yourself as a potential investor, well, wait a minute. I thought this is a startup. I thought they'd want to be investing in the company to really grow and get this thing going, to take off. It is a capital allocation question. So yeah, well said. Danny, if you wouldn't mind, I know you like incorporating dividends as part of your overall portfolio. What are some of the motivations you have? What are some of the things that appeal to you? What do you like about the strategy? And do you also have any concerns about having that strategy?
Sure. So I will say that our 401ks and our Roth accounts are primarily geared towards growth. My dividend holdings are in a taxable brokerage. I guess what I like about them, there's definitely a psychological aspect there where I used to have an app on my phone. I don't anymore because I don't want to be checking the market like that. But when I did,
Smart.
One of the things that I really enjoyed was waking up and getting a notification, this dividend has been paid, or this dividend has been paid. Like, it was like, it's a little boost to my morning to see that, come in, to know that I earned money on the money that I have working for me without having to do anything. It literally came in. I got the notification while I was sleeping, right? That was kind of a cool little psychological effect for me. In some other ways, I think it makes it easier to hold stocks. As long as the company still looks strong, it makes it easier to hold on to those equities during downturns. And rather than feeling like I'm losing out on money, a lot of the time I feel that I just have a chance to buy in at a lower cost and to lower my overall cost basis and have a better return for the long term. So I enjoy seeing those come in. I like the ability that it makes, or the fact that it makes it easier for me to hold on to them. And I also want to build a passive income stream. I don't want to have to sell off individual shares or pieces of the capital in order to have income coming in. Now, there's certainly other ways, to do it. And, I could buy bonds and look at other ways of earning interest, but I enjoy dividends, and I just like them. And I do keep them only in my taxable brokerage. And it might be a little bit, well, we can talk about taxes in a little bit. However, There are some downsides as well. Dividends are not guaranteed, right? They can be
Right.
canceled. There have been many companies in the past decade who have cut or ended dividends entirely based on, economic conditions or the status of their current business. And they're not guaranteed. So that's something you have to plan for.
That was an awesome response. I was going to take a moment to share some of my thoughts on it too, but quite frankly, you summarized a lot of the same views I have on dividends. I think that's actually a good segue to jump into some of the pros and cons, because I think you actually just hinted at many of them, but I want to explore them a little bit. So some of the pros of investing in dividend-paying stocks or dividend-paying stock funds, if you will. To your point, Danny, it could be a form of stable income, right? Some companies are actually committed to growing their dividend year over year, right?
Very true.
That could be one way to look at it. Is not only could it be a stable return of profits to shareholders, but it may also be positioned to fight inflation a little bit if the company's committed to growing that dividend over time, hopefully in a sustainable and rational manner, right? Not doing it because they feel pressured to do so, but because they're taking prudent business decisions to actually make that happen. To your point, you did reference the taxation piece, right? And there is, when it comes to stock paying dividends, or dividend paying stocks, I should say, there's something called qualified dividend treatment. Danny, you and I have actually mentioned this a couple times in prior episodes. To our listeners, I'm not going to go into the nitty gritty on it, but essentially, in order for something to be considered a qualified dividend, it has to generally be a U.S. company or a qualifying foreign company. Can't show up on, I think the IRS actually has like a list of things that don't qualify for a qualified dividend. And there's also a certain holding period that has to be met. And I'm not remembering the exact details. It's like more than 60 days within a certain 120 some day window that has to do with the timing of when the X dividend date is.
Absolutely.
I can't recall it off the top of my head. For most people, if you have qualifying companies that otherwise will have qualified dividends, if you hold them long enough, just by default, and you're just holding them and not selling them, they're likely going to turn into qualified dividends.
Absolutely.
Just by meeting that holding period.
If you are a buy and hold investor for the long term, then it's going to be much easier to earn those qualified dividends.
Right. Yeah. And again, these are U.S. companies or qualifying foreign companies. You can look up the terms online if you Google it, like what is considered a qualified dividend. Bond funds, for example, Danny, you mentioned how they pay out dividends. Those are not qualified dividends. Those are ordinary dividends.
Because those dividends are being generated from interest, correct?
Yes, and I also think because by definition they don't meet the definition of a qualified dividend as well. But yes, because they are generating interest, I believe that's correct.
One aspect may be the fact that qualified dividends, I believe, have to come from the profits of business activity, and the dividends from a bond fund are coming from interest on debt notes, essentially.
That would make sense. I don't know for sure.
Sure.
But
yeah, don't quote me, but that may be one of the reasons.
I would be curious to look up the rationale. Like, why is it that the IRS considers that a qualified dividend and not an ordinary? And again, for the listeners, qualified dividends from companies that pay dividends, they're taxed at long-term capital gains rates, which are more favorable tax rates than your ordinary income tax rates, right? They have different tax brackets applied to long-term capital gains, and those get applied to qualified dividends if your dividends are qualified.
Absolutely. Which is one of the reasons why I am okay with them being in a taxable brokerage.
Right. Yeah. It's kind of like just a tax advantaged way to pay taxes on the dividends that get paid out, increase your cost basis over time, and kind of manage those year over year. And to your point, Danny, I really like how you said one of the pros to you was that it makes it easier for you to maintain your shares and your holdings. You don't like the feeling of having to sell your shares.
I don't want to share.
No sharing. That is a common sentiment I hear people talk about with dividend investing. There is something that happens when you get to a point in your life. Could be retirement. It could be stepping away from work or doing an early retirement. Maybe you're part of the FIRE community, financially independent, retire early. Whatever the case, when the day comes when you have to tap into your savings or your investments to provide yourself with income, there is a psychological stressor that occurs when you have to sell shares because you feel like you are actually getting rid of something, you're giving up something that you worked to acquire. Now, should that be the driving force that dictates that you just go towards dividends? No, but that is something to be mindful of. It's just a psychological element that does come to play a role in the decumulation stage, if you will. Another pro to dividend paying companies, you could view it as a way to diversify your portfolio, right? If you were overly allocated towards strictly growth companies, having some companies that pay dividends in your portfolio may round out your diversification a little bit. It's not going to guarantee that you have better investment returns, but maybe it reduces risk in your portfolio because you're further diversifying, right? Hard to know, but that's an element to be aware of. You could view that as a pro. Some of the cons, Danny, I also think you mentioned this one. You may miss out on growth, right? So remember, when a company is choosing to pay a dividend, that is cash they cannot reinvest into their company for future growth. Now, that may be the right thing to do, right? If a company is mature and they really cannot get a better return on investment by retaining that cash and reinvesting it, perhaps it is to the best interest of the shareholders to just pay it as a dividend. It's hard to know. But one of the cons you could say, broadly speaking, is when a company chooses to pay a dividend, which is a capital allocation decision, it does raise the question, are they best deploying that cash by sending it to shareholders when they may be able to deploy it to something else, right? Maybe they have high debts, right? Maybe they could pay down debts instead, right?
Absolutely.
So, or maybe they have an opportunity to expand their business.
And
hard to say.
Speaking of debt, when you're looking at dividend paying companies, and if you're looking to add dividends into your portfolio, you do not want to see companies maintaining high levels of debt or taking on debt in order to pay these dividends. Dividends need to be, if they're going to be safe and healthy for the company, they need to be paid from free cash flow after all operating expenses.
Right.
So that's something to definitely keep in mind.
Let's riff on that for a second, because I think this is a really important point you bring up. If you are unable, first of all, even taking a step back further, if you are unable, you do not have the skill set or are unwilling or don't have the time to know the companies you own, owning individual companies may not be for you, right? If you don't know where to look, or if you can't even regurgitate whether the company you own has high levels of debt or what their debt levels are, there's a risk there. Focusing on a fund instead may be better suited to you.
Absolutely.
It gets risky when you own individual companies. You may not know what their debt levels are. You may not know what their cash position is. You may not know what their free cash flow is. It's important to know some of these things.
Yep.
Now, to your point, Danny.
There are definitely dividend ETFs and other such mutual funds, things like that can help kind of lower some of the education and skill needs if you are looking to get into dividend equities.
Right. And also it begs the question, right? I mean, how many of us could actually outperform, funds and whatnot? I don't know that I could, right? So
just make sure that the expense ratios on those ETFs and mutual funds, et cetera, are appropriately low enough.
Yes. But to your point on the debt levels, right? So this is another con that ties into your point, Danny. There is very much a culture around dividends, right? If a company has been paying out a dividend for some years and investors are relying on that dividend, they've come to expect it. If they cut that dividend, even if it was a prudent financial decision, it was the smart business decision to cut that dividend and deploy the cash elsewhere, that share price on that stock is likely still going to be negatively affected. People get angry when companies cut dividends.
They sure
and it's such an interesting phenomenon that culture, that mindset, that I don't know what you would call it, that affects the share price on the stock. And I would argue it's irrational, right? If I'm a shareholder in a company and the company's paying dividends and they have been for years, and it so happens to be that it would be prudent for them to cut or not pay their dividend for the year, that makes sense to me. It doesn't make sense to me that that people should all hell should break loose and people you know get upset that a dividend was cut. That may be a prudent thing for a company to do.
Sure.
But just know that because of this dividend culture that exists, this expectations that companies keep paying that dividend, and if they miss a single dividend payment or they cut it, then they're going to suffer the consequences.
That is
it's
fair.
kind of a weird irrational dividend culture that does exist, and it does affect stock prices.
There
and fund
may
prices.
be some arguments there. If you still very much believe in the company, there may be some arguments that is your personal time to get in.
Yeah. If you have the conviction that
Yeah.
is something that you think is a good buy, I can't tell you that. But if you believe that, the rational side of you should be saying, well, maybe this is a good entry point. But dividends being cut could also be a sign of financial stress for the company
Also
too,
true.
right? It could be that they are struggling financially. They're overburdened with debt, like you said. And Danny, you're right. There are companies that are taking out debt to continue paying a dividend. It's not super common, but it does happen, right? It does happen. Another thing you could look for is a payout ratio, right? So you can look up a company and you could see what percentage of their free cash flow, their profits, is being paid out in the form of a dividend, right? And you can Google like what's a good payout ratio to be underneath. You'll see online like as long as it's below 30% or below 50%. When you see that percentage, it does give you a little bit of a wake up call. It's like, whoa. Wow, this company, on all of their free cash flow, the only cash they have available to do anything with, to pay down debt, to reinvest in the company, 70% of it's being paid out as a dividend, 80%, 90%. These are things to be mindful of as well. Again, it's not necessarily a bad thing. It's not necessarily the end of the world, especially if a company is very committed to returning profits to shareholders and that's their strategy. But it is a con to be aware of. Debt levels, payout ratios, things like that. And to your point, another con very quickly is, like you said, Danny, and we mentioned this just a few minutes ago, if the dividend income you were receiving is not enough to meet your income needs, you may be forced to sell some shares to meet income needs, assuming you don't have adequate reserves elsewhere. And if you do that, your income will then decrease moving forward, right? Because if you sell shares that are paying dividends, you now have fewer shares that are paying dividends.
Yep.
Thus, your income is decreasing. So those are some of the cons to be aware of. I want to talk, Danny, this is an area I'm excited to jump into. This is often an area many people aren't familiar with when it comes to dividends.
Okay.
And I'm calling it common misconceptions about dividends. So I have, I think, 3 points I wanted to share. I'm curious to get your thoughts too, but I wanted to share these with our listeners just so they're aware. The first one, I'll often hear something along the lines of, dividends are really important because, I mean, think about it. 32% of the S&P 500's total return comes from dividends alone, right? The other 68% is from capital appreciation. And so I'll hear that thrown around a lot, roughly, close to a third, right? It comes from dividends. I don't know how to say this without sounding like a jerk, but yes, that's inherently going to be true because the S&P 500 is simply the 500 largest companies in the U.S. by market cap.
Yep.
Some of them happen to pay dividends.
Yeah,
and
they
because
just so
that
happen
is the case,
to be well established.
They just so happen. Exactly. Because they just so happen to pay dividends, of course, part of the total return is going to be made up of dividends. But if the largest 500 companies in the U.S. didn't pay dividends, then there would be no dividends. People use this quote as like a reason you should be focusing more on dividend paying stocks, as if they make up some critical portion of a return. That may be the case, but using this quote could be misleading, right?
Sure.
Yes, of course, a portion of the S&P 500's total returns from dividends, but that's simply because there happen to be companies in the top 500 that just happen to pay dividends. So, naturally, logically, that's just going to happen to be the case, right? So I wouldn't think too much into that. I think people get too caught up thinking about one certain point, thinking that it should dictate their investment philosophy, when they may be missing, what's the phrase, missing the forest through the trees? Is that the
something like
phrase?
that?
Something like that. I'm probably going to sound silly messing up that quote, but another point that is a common misconception: a lot of people think dividends are declared as a percentage, and they get so hyper focused on this percentage. Wow, this company is paying a 5% dividend. That's awesome. I want to dismantle this really quick because Dividends are not declared as a percentage. When the board gets together and they're making a vote on what dividend they're going to pay out, nobody is sitting in that room going, why don't we raise it a percentage point or lower it a percentage point? It has nothing to do with percentages whatsoever. A dividend is declared as a dollar amount, right? So I'll give you an example.
Board. Yep.
Yes, I'll give you an example. Let's say a company's currently trading at $100 a share, and the board says, you know what, let's declare a $1 dividend for this quarter, right? And so if you were to take that and multiply it by 4, because there are 4 quarters in a year, that would, assuming that the dividend is the same for all 4 quarters, you would get $4 over the course of a year.
Okay.
So that would be a 4% dividend. But the reason it's 4% is because it just so happens that those 4 quarterly payments of $1, or a total of $4, divided into the $100 share price happens to be 4% of the share price, right?
So the board declares the dollar amount of the dividend that will be issued, and then the percentage is calculated by people outside of that company comparing the share price with the dividend payments.
And that percentage is going to fluctuate daily, right?
Yep.
If they declare a $1 dividend to be paid quarterly, and you multiply that by 4 for 4 quarters in a year, so $4, and that share price goes up to $150 a share, well, that dividend payout, that 4% is going to drop, quite substantially.
Mm-hmm.
Staying on this percentage point for a moment, this is why you will see companies that are dividend growers. You can look up companies that have been increasing their dividend for decades, some even like greater than 50 years, right? Like they've increased their dividend every year for more than 50 plus years, some companies out there. So you may ask yourself, wow, this company is only paying currently a 2.1% dividend.
Mm-hmm.
How in the world have they increased it for 50 years if it's only at 2.1%? Like, what did they start at, like 0.01% as a dividend? Again, that's not how that worked.
Yeah, the share price has been appreciating.
Exactly. The share price has been appreciating. And so, of course, the percentage is going to drop, right? Let's take that $100 share example. Let's say that board then declared a $1.25 dividend. They increased the dividend by 25%. That's huge, right? That's massive. And assuming that $1.25 dividend gets paid out quarterly 4 times a year, that's $5 a year. But let's say at the same time, the share price itself grew from $100 a share to $150 a share. Well, that $1.25 dividend, or $5 for the whole year, is now a 3.33% dividend. But it grew, right? So you're going to miss the whole point of what a dividend is and how it grows if you're just looking at the percentage. Stop looking at the percentage. It really doesn't mean anything. The only thing, it's just a byproduct of the dividend being divided into the share price. That's all it is. That's all it represents. And so, the only time looking at the percentage could cue you into something is if you see a really high percentage of a dividend, you can ask yourself a few questions like, whoa, okay, if the percentage is that high, perhaps the share price has dropped a lot recently, right?
So that's very easy to see. Just look at that past timeline online.
Right? I think that's the one thing I wanted to really help dismantle from people's minds is stop focusing on the percentage so much.
Very good.
The last one, this one, I think surprises some people. I have heard this said a few times now, people I've talked to who like dividend investing. I've heard this from multiple people. I'm just going to summarize it something like this. Well, you know what? This dividend fund is paying about 4% yield right now. So even if nothing happens, at least I'm getting a 4% return for the year. I'm going to explain why that's not true, right? So let's go back to this $100 per share company that's paying a $1 quarterly dividend. If they pay that $1 dividend, that dividend is coming from their surplus, from their profits, from their cash. Danny, if my company's worth $100, right? My company's worth $100, and part of my company has $10 in the bank, right? The other $90 is value from like my intellectual property and other things that I have, other assets.
Yeah, actually doing business.
Yeah, actually doing business. Yeah, but 10 of it is like money I have in reserves in the bank, right? And that calculates into my market value of $100, right? If I take $1 out of my $10 and just pay it to my shareholders, how much is my company now worth on the marketplace?
Yeah, it's going to be $99 because you've pulled one out of the total assets. So that's something to keep in mind.
Right.
The cash, hypothetically, free cash flow being used to pay dividends, that is cash sitting on the balance sheet. That is cash that is increasing the asset allocation and the assets on their balance sheet. So that is driving up their share price because it is an asset, and that gets, pulled from that asset total and given to shareholders. It is naturally going to lower the share price.
Right. So if a company's trading at $100 per share and they pay out $1 for the quarterly dividend, that share price is going to drop to $99.
Mm-hmm.
Right. So even though that you received that dividend, your net holding has not changed. You don't have $100 plus the dollar they gave you. You now have a $99 share price plus the dollar they sent to you. Now, can that 99 then appreciate back up to 100? Yes. Yeah, it can. Perhaps.
And that is honestly what you're hoping for, right? In owning a dividend paying company, you are hoping that they have the free cash flow to both deliver on those dividends and continue to grow the company.
Right.
To offset
and some people,
that drop. Yeah.
Right. And some people may reinvest that dividend, right? And so now maybe they own 1.01 shares, right? If they took that dollar and reinvested it, and then if that appreciates back to $100 per share, then they see, their dividend, which was reinvested into the company, maybe appreciated because they now own more shares than they did before because of reinvesting. So, but yes, the point is, you'll often hear people like, well, as long as I'm just getting the dividend, that's going to be my return. Not necessarily, because when the dividend's paid out, the price of the company itself does drop. The other thing too is some people will try to get cute and buy or sell a stock before or after the dividend is paid out, right? So maybe they're like, oh, if I time it right, I'm going to buy this company right before the ex-dividend date so I can get that dividend. So now I'm getting the share price for what it is, but I'm getting a return right,
and then
right
you
there.
pay ordinary tax rates on that dividend.
Yeah. If you really think about it, it's like, here you go, company, here's my $100. And the company is for somebody doing this, and the company goes, great, here's $1 back. By the way, you're going to pay taxes on that now. And you're like, oh, well, that's
absolutely
lovely. So, again, like, I'm trying to dismantle some of these common misconceptions that people have about dividends, that there are complexities to them, and it's not like some magic thing that is going to enable you to have some type of like special secret returns and be able to game the system. And it's not that. Think about it logically, and what does a dividend actually mean? What does it's a return of profits to a shareholder. And yes, the company will have to adjust its market price lower because they're paying out cash that they no longer have on their balance sheet, as you said. Danny, I want to go into some advanced strategies, some slightly more advanced things with dividends. So I don't know if I consider this advanced, but let's talk about reinvesting dividends really quick, right? So people who do have stocks or ETFs or mutual funds that pay out dividends, you're going to have two options generally. You can either just have all dividends just be reinvested into the funds or the companies you own. That's sometimes an option for you to do.
Yep.
If you do that, your cost basis will just incrementally increase, right? So like you basically, yes, you pay taxes on that dividend still, even though it's reinvesting, but then your cost basis is going to go up because it's basically like you've taken that money, you've paid taxes on it, and you've then reinvested it into the company, right? So,
and I just want to touch on that again. I know I've mentioned it in the past, but yes, even if your dividends are reinvesting automatically into these companies and you never saw a dime of that hit your bank account, you owe taxes for that year. So you need to work that into your budgeting, right? Yes. I have a separate account. I have a savings vault within my savings that is tax only, just in case I've miscalculated anything and I end up owing a bit more. I already have those funds set aside to make those payments. If you are not accounting for this, let's say someone is going ham on dividends and they have built a portfolio that at this point, they're still working, but at this point, it is earning them $20,000 a year in dividends. And you have not accounted for this tax, that is going to hurt at tax time. So just keep it in mind. calculate what you might need to pay, and just be aware of it.
That's a really good call out, because yes, you don't want to get that 1099 mailed to you come tax time and you're like, oh wow, I've got a big tax bite for all these dividends I've received.
Oh, what's the Simpsons thing? I'm in danger.
I'm embarrassed to admit I didn't watch a lot of Simpsons growing up. I need to get on it so I can be culturally relevant again. One caveat to your point, Danny.
Sure.
This is assuming you're investing. These are dividends being paid in a taxable brokerage
Yes,
account.
yes.
For example, if you have funds that pay dividends in your Roth IRA or your 401k or whatever it is, you're not going to have to pay taxes on those because it's tax deferred. So, but that's a great call out, Danny. Really, really good. So yeah, you might ask yourself, should I reinvest or should I just have it pay as cash? Some people, there are pros and cons to each, right? So some people just want to set it and forget it and not deal with like, okay, yeah, it was paid out as cash to my brokerage account's cash account. Now I have to manually log in and reinvest those dividends to wherever I want. And if you're not on top of that in a timely manner, you may miss out on market growth, right? If you forget to log in for a day or a week and the market has moved since the dividend was paid out, well, then maybe you didn't get to reinvest it at the right time, right? Now, the opposite could also be true. You may just get lucky and maybe the market actually goes down and because you delayed, you get to buy it at a better price. But do not try market timing. It's not going to work out in your favor. So that is a con to be aware of. However, I will say, if you do have dividends paid as cash, you have a little more flexibility with how you want to divvy them up when
Certainly.
you invest them, right? Like maybe different holdings in your portfolio have appreciated or depreciated at different rates. And so dividends coming in, you may be able to like rebalance more appropriately, like put some of those dividends towards assets that have dropped in value as opposed to just dumping it back into one that has been appreciating.
Yep.
Again, that's not guaranteed to be better performance, but you could argue that you have a little more flexibility to
maybe you're aiming to put some additional capital into a sector of the market that you're very low in, and you want to bring that up kind of in line with the rest of them.
Yeah, but again, if you're the kind of person that's like, I just don't see myself being able to log in and take care of that and be manage that in a timely manner very prudently, maybe just having it reinvest and forget it, set it and forget it is the way to go. It's just going to depend on who you are and what your situation is. So I mentioned this briefly before, Danny, but some people like to own individual companies. Some prefer to do ETFs or funds. Again, I just want to caution people that, investing in stocks, whether it's individual or through funds, comes with risk. You have to really make sure that you know what your risk tolerance is and make sure your other financial goals are taken care of as well. Make sure you have an emergency fund. And if you are not comfortable with investing and you don't have the skill set or the ability emotionally to make rational decisions under pressure when the market is being tumultuous, you got to be careful about that. And maybe individual stocks isn't for you. And maybe investing on your own isn't for you. Maybe you need an advisor. It's, be honest with yourself in what your personal education level is on investing, and just be cautious, because the markets can be volatile and there is risk of loss, right? So be mindful of that. Individual stocks are a bit harder to manage, right? It is very difficult to be on top of every single individual company you may own and be very aware of what their underlying fundamentals are, keeping track of their debt levels. Are you reading their annual reports to their shareholders? Are you, are you staying on top of that? It could be a lot of work. So just
very, very true.
Be cautious, be honest with yourself, and choose a strategy that is going to really reflect you as a person, and don't overextend yourself into something that you don't understand.
I think I mentioned, just very briefly, in a previous episode that when I first got into investing, I bought way too many individual stocks, and that I have been gradually consolidating and paring down, just because I do want to, for the most part, set it and forget it. I don't have time to, be reading and jumping on all these earnings calls every quarter or every year. So consolidating, and as we said, financial minimalism and kind of cleaning up what you have going on in your financial life can be very beneficial.
Definitely. There's lots of different strategies you can employ with dividend investing. I want to give some closing thoughts, Danny. Let's bring it back to some of the basics. Dividends are not the end all be all, right? So there's nothing necessarily special about them, but they have their unique characteristics, right? They're returning.
Okay, that's fair.
They're returning profits to shareholders. It may be a stable stream of income for a lot of people. Like you said, Danny, it's this psychological benefit of like, hey, I know I'm going to get this income. I like this idea of passive income without having to sell my shares. If that is attractive to somebody, especially if you're getting to a point where you're going to need to have that income for living needs, maybe that's a strategy that you could employ as part of your overall portfolio. I think I want to emphasize that though, as part of your overall portfolio. Some people get really carried away with going like, what did you say earlier? Going ham on dividends. On dividends. Yeah. Going all out on dividends. That may not be the best decision to do, right? It just, you may give up some things on growth. You may
Absolutely
lack diversification in your portfolio if you just focused on dividend paying stocks.
Like I mentioned before, dividends are a focus of one of our 5 accounts.
Yeah. And I also like that you specifically have your taxable brokerage account being the focus for your dividend paying funds because of just, leveraging the qualified dividend tax advantage, which is really cool. It's like getting selective with where you place your assets within certain accounts. I think that's a really good example. So yeah, I think just be mindful of what you own, understand what dividends are and understand what they're not. Like remember some of those misconceptions we talked about.
It's not free money. It doesn't appear out of thin air.
Again, Danny, we say this a lot, but there are so many different strategies out there. I think the important thing is if you're at this point in your investing journey where you could even consider doing dividends, right? And I say at that point to emphasize the fact that you shouldn't even be investing unless you are in a position to do so, right? You don't have crippling credit card debt. You've paid that off. You don't have a lack of an emergency fund, right? You have an adequate emergency fund, right? You're in a position where you are saving and investing for the future. And if dividends sound appealing to you because of how they may play a role in your portfolio, and that is motivating to you. I mean, Danny, to your point, like I know you've said that you're motivated to get your passive income, your dividends to a point where it would be able to pay for your mortgage, for example.
Absolutely. Yep. Just another safety net.
Right. And I love your example because you're acknowledging what dividends are and what they are not. You understand what you give up when you invest in a dividend paying company versus not, right? You understand the play on diversification and how it rounds out a portfolio and how it may or may not improve your performance. But what I love that you focus on, Danny, is you acknowledge this, hey, it's a motivating element. I like to have it as part of my overall strategy. And that motivates me to save more to get it to a level of passive income that could offset my mortgage, for example. I think that is a great example to think about for our listeners. Think about how something like this, if it appeals to you and it could complement you in some way and you're in a position where you could safely pursue a strategy like that, then great. Maybe that helps round out part of your overall financial strategy. I think that's all I had to say, Danny. Thank you so much for sharing your stories today, your own personal thoughts on dividends, and thanks to our listeners for joining us and nerding out on a dense topic just on dividends for a full hour.
I mean, realistically, we could dive into this for several hours, but I think that we've hit a lot of really good points, and I appreciate you talking through some of those kind of nitty-gritty specifics. For the advanced aspects, I hope that we didn't lose anybody, but if it got a little confusing, I encourage you to look some of this stuff up online. Maybe you'll learn something you didn't know earlier in the day.
Yeah.
But yeah, it's been fun. And to everyone, hope you enjoyed it. And as always, have a great week.
Awesome. Thanks, Danny. See you all next time.